Will the stock market really only give a 3% annualized return over the next decade? That's the question I'm posing today. I don't really know the answer. And to be frank with you, I'm not a huge stock market guy. I have a good amount of money from retirement accounts from the NFL, 401ks, cap plans, different 401k strategy plans within my businesses. So I have stock exposure, but it's not a major part of my planning. I really just do index funding when it comes to the stock market for the most part. But it begs a question on like what should be your investment strategy for the next 10 years. Are they right? Are they not right? I'm not sure, but I know they have a large team at Goldman Sachs and they really look at the numbers and they are predicting an average 3 to 5% return on your money for the next decade, which is a huge difference between what it did the last 10 years and what they're projecting it's going to do the next 10 years. The last 10 years been 13 to 20%, or 13 to 20% in the stock market on average in that range. And it's performed great over the last decade. So if you're in the stock market, if you just invested in index funds, kind of how I do, you've done really well in the stock market. But the next 10 years are not projecting out that same way. That's what Goldman Sachs predicts, that 3 to 5%. There's other people who are in the 5 to 7% range, what have you. But what I will say is nobody's really predicting double digits over the next 10 years. So are they right? Are they wrong? I'm not sure. But that makes me want to pose the question, what should you be investing in if the stock market's only going to be, in that 3 to 5, maybe 6, 7% range? And there's no consistent cash flow. See, my answer to that and why I started my lending company in the first place is private lending. When you look at it at the national level, you're going to see people talk about it as private credit. And all that means is lending to other businesses or real estate projects and getting a higher return on your capital because you are lending. You're essentially becoming the bank. There's ways you can invest in these private credit funds, private lending funds, hard money funds. There's a lot of different terms, but there's ways you can passively invest in them and get a good return, or there's ways you can do it by yourself, which is what I've done within my lending company, 42 Solutions. And why it's advantageous right now is instead of having a 3 to 5% return over the next decade, and there's a lot of volatility within that, you can place a portion of your portfolio in privately held loans that are backed by real estate, or some private credit funds are backed by businesses. So, you kind of pick what you're most interested in, and you could still make double-digit returns or high single-digit returns on your money that relatively safe because the collateral is assets and real properties are real businesses. So this is a very advantageous time to consider that. And I don't think enough people really are because they don't know about it. But when I started to read books like Tony Robbins' Money Master the Game and his newest book, Unshakeable, he talks about how private credit is a huge lane where a lot of wealthy people are placing a portion of their portfolio because it's consistent income. Now, what I've started to see over the years is like, okay, stock market is volatile, but overall you should get an annualized return of 8 to 10%. Well, that's not really cash flow, and that's up and down. So having a lane that you're investing in where you're getting consistent income and cash flow is really, really something to consider, and why I started my company. Because I'm like, even though I'm not a stock market guy, I'm like, okay, that's going to do 10% annualized, and that's what it'll do. I have real estate, but the cash flow is not great. I'm betting on appreciation, tax benefits. Well, this lending, I can actually operate as a business, but it's in a business that I'm an investor in myself, and I'm getting good into the double-digit returns on my capital. This is a good place for me to place my own capital. So that's kind of the revolution I had personally, and something that I'm leaning into. And to go with that is the actual real estate. So I'm putting a lot of capital into my lending company, 42 Solutions, but I'm also continuing to buy and reallocate into real estate because within real estate, I get cash flow. It's not as high as what my lending will do, especially in today's times, but I'm still getting cash flow. But more importantly, I get to participate in appreciation and tax benefits, which lending does not provide. So I'm using lending as my cash cow that's allowing me to live, to reinvest, to compound wealth that way. And then I'm, kind of taking off chips off the table there, placing it into real estate where I get appreciation, tax benefits, and allowing those things to balance themselves off. So now I have a portfolio portfolio where I have retirement stuff in the stock market that hopefully does better than Goldman Sachs is saying, but I'm letting that roll. Then I have private lending where I'm generating a consistent income and that's allowing me to live my life, reinvest, etc. And then I have my real estate portfolio that is continuously growing in appreciation and tax benefits and things like that. And I felt like the combination of the three is really important. But the people out there who've been really lenient into the stock market, the question I have for you is it time to lean more into private lending, private credit, what have you, and into real estate and owning assets that are appreciating? I think now, if Goldman Sachs is correct and the returns over the next decade are going to be that much lower, I think now is the time to reassess your balancing act and your diversification and maybe start to get into some private credit and some real estate. So that's my challenge for my stock market people out there. I'm not a stock market expert. I don't pretend to be, so I'm welcoming all the feedback, but I saw that kind of headline from Goldman Sachs and I'm like, that's interesting, and that's something I wanted to kind of address here. So if you guys don't already, make sure you click subscribe here for the Capital Edge, but you can also go to the Capital Edge newsletter where I dive into similar topics and I kind of, in written form, really give my thoughts, feedback on what I'm doing within my businesses and within my investments and how it might apply to your life. So let's keep building together, and I'll see you guys next time.